The world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Matt Harris, a partner at Bain Capital Ventures, focused on fintech and financial services. Matt is a fintech legend in New York. Everyone I talked to about this conversation knew Matt and sang his praises effusively. Matt has been an early-stage investor since 1997, which is basically forever in fintech years. His portfolio includes Acorns, IEX, Roofstock, SigFig, and many more. Matt has highly developed views about the future of payments, lending, banking, and investing, which we work through in our discussion. In addition to the insights we deliver through our podcast and newsletter, Rebank offers advisory services to fintechs, banks, and corporates. Drawing on our experience starting, running, and advising fintech businesses, and our vast network of the most impactful fintech entrepreneurs, investors, and innovators around the world, we help companies make sense of fintech, work through specific questions, and optimize proposition and strategy. For more information about our services, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Matt Harris. Matt Harris, welcome to Rebank.
Happy to be here. Thanks for having me.
So I give a quick intro to you and Bain Capital in the intro, so no need to repeat here. It would be fascinating maybe to kick off and dive right in. If you could tell me about one company that you're particularly excited about right now. It could be a company you've invested in or haven't.
Sure. I have a hard time picking amongst all my children, so I'm going to pick the company whose board meeting I have today, right, so I can objectively say as to why. So that company's called Acorns. It's a company that's based outside of Los Angeles and got started in life providing a micro savings app for folks here in the United States that basically helped them round up transactions and in using other behavioral finance mechanisms save money pretty painlessly. The average Acorns user saves $400 or $500 a year. The average Acorns user had no savings when they started, so it's proven to be useful. And then, like a lot of different B2C fintech companies, it has rounded out its suite of offerings to what now looks like a proper bank. We offer a debit card, we offer an IRA, retirement account, as well as our investment savings account, and increasingly are aiming to be the bank of the future.
Man after my own heart. This is a subject I spend a lot of time thinking about. So I think actually today, as of the date of recording, we'll push the conversation we did with Chime. We've had Dee Choubey of Moneylion on, John Stein of Betterment, Colin Walsh of Varo. So people kind of approaching what ends up looking like a kind of a medium-term strategy that kind of looks similar, but approaching it from different entry points. What better place to kick off the conversation? So maybe the million-dollar question is there an optimal entry point if the end point that you're seeking to achieve is a comprehensive, connected financial services offering?
Well, I'll start by saying I sure hope it's worth more than $1 million. Based on the aggregate valuation of the companies cited, it needs to be more like $10 billion. Well, we've made our bet, which is that the optimal entry point is a sort of low-friction, top-of-funnel app download. And that, in the case of Acorns, has resulted in 5.2 million users growing very quickly without a lot of marketing spend. So an extremely low cost of customer acquisition to get a user fully through the funnel of registering their existing payment cards. So you start this extremely data-rich relationship and you get access to their money, which they're saving in an account being invested for them. I think the other approach, which is more like what Colin and Dee have done, is to start with the most profitable line of business, which is, of course, lending. And no one is going to succeed in consumer fintech without lending, in my view. There's just so much of the margin in banking comes from credit that it's an ultimate destination. And so I think there's a good argument that you should start there, that should be inherent in the DNA of your company, and that you can actually add a lot of things later. My preference was the opposite, was that, start where you can get scale, and then you can tack things on later in the day. And it quite possibly means that the nuances of Acorns credit product when it arrives will be, less than Varo. We have Colin, who's obviously a lending expert, or Dee, who really started Moneyline with the idea of credit in mind. And so maybe Acorns never kind of catches up on that dimension. But I also think in a world where we don't think consumers are going to have 16 of these things on their phone, that there is a bit of a land grab. And so if you look at what Acorns and Stash have done, I think similar to each other and distinctive from the field, it's been about scale user acquisition. Yeah. Probably most similar to Robinhood, I would put in that category as well.
Because, you basically have these two distinct approaches, one being the kind of VC-funded customer acquisition approach, kind of scale customer base as quickly as you can and then look to monetize by rolling out other products, versus the start with as close to a unit economics kind of business model as you can, and then potentially afford yourself some flex into how quickly you manage to scale. I think the point that you're making is that given the land grab nature of the market right now, having maximum customers is more important than being unit economics stable early on.
With one caveat, the most important decision, I think, in the history of Acorns was the decision to charge $1 a month. Because I wasn't around at the time, but I imagine that there were people at the board table who said anything that engenders friction we should dispense with. But that turned their payback period from infinite to 8 or 9 months. And it has been instrumental in maintaining some level of capital efficiency in that business. So I think you can go too far. Now, Robinhood obviously has 0 fees, but had a payment for order flow model out of the gates, and they monetize on options, they monetize on lending, they have premium accounts. I would say they were the most extreme out of the gates, where none of those things actually matter in the first year or two, because you didn't have enough order flow to matter, you didn't have enough assets to matter. So they were truly going naked on unit economics, but they engendered virality like none of the other companies have as well.
Are you bullish on Robinhood?
I respect their success. Again, showing my colors here, I have a significant investor in a company called IEX, which is capital markets.
Well, they're famous for the book, right?
Yes, they were featured in this book, Flash Boys, which was fortunate for us. And but the point of the company is that systems that are set up to favor high frequency traders are not in the spirit of fair and open markets. And it's a point of view that's been characterized, or I'd say caricatured in certain ways. And the book actually caricatured it a little bit, but at its core, it's not a really controversial statement. And the management team there would say, and I agree, that payment for order flow isn't particularly consistent with the kind of market systems you'd want in place to ensure true best execution for everybody. And so to me, I don't think that that's a great monetization strategy. I think particularly if you're calling yourself Robinhood, that feels tough.
So a good customer acquisition strategy potentially could be optimized over the longer term.
Yeah, I think that there's plenty of ways to make money when you have this zealous clientele that they have trading away like beavers. I think they will move away from payment for order flow, and I think they can move away from it. But that dissuaded me in the early going, which, obviously to my detriment, because it's been a great investment.
So show my ignorance here, but Acorns, is part of the model that the money that you're saving either gets kind of invested in an automated way, or they facilitate you, reaching savings goals and then making purchases at the end of that?
Really the former.
Okay.
It is about, they have baskets of ETFs that are, based on your risk preference, and you can move in and out of them. It does serve as a piggy bank as well. We have lots of users who habitually go to zero and then rebuild and go to zero. But the average user just steadily builds. And that's obviously the kind of user we're trying to cultivate, not just because the AUM is useful, because frankly, we don't charge basis points. We think that that's the wrong way to think. For this user, basis points aren't the right way to think about it. It's really a service that they pay for. But we're trying to improve their financial health, and obviously kind of an emergency savings pool that you don't pull down, quarterly is a better thing. Mm-hmm. I do think, when people, as I think about credit, for instance, I think one of the advantages that Acorns has is that we should be able to, in effect, lend people their own money. That, on one hand, you should be building the savings. On the other hand, we know you need money from time to time, but don't draw down your savings. There's a way in which we can make sure you don't ever overdraft. We can make sure you don't ever take high-priced loans because, frankly, you have this wealth that you're building.
So it's a collateralized consumer loan, basically.
And that would be an example of something that Acorns can do in the credit space that is hard for others to do, and consistent with the ethos of the company.
No, that's interesting. And you mentioned the importance of lending before, and interesting that I think this is a key difference. Obviously, credit is a key difference between the U.S. and other international markets, but I think a key driver of a lot of business models which may be viable here that aren't elsewhere. You think about digital banks in the U.K. and Europe, kind of credit-light economies. If you're not lending money to customers, it's really difficult to be profitable on an otherwise free banking or free savings or free investment product.
And no interchange.
Yeah, exactly.
Or reduced interchange.
Yeah, and so the lending is helpful in terms of monetization. At the same time, we're seeing various verticals in financial services kind of trend toward zero in terms of fees or margin, maybe less margin, but more fees. I mean, if you're talking about the investment space, if you're talking about payments, if you're talking about bank accounts, a lot of that is moving toward zero. You can definitely monetize through lending, as we're saying. Is it important that companies get creative or start to get creative around generating revenue from otherwise kind of free or freemium direct-to-consumer models?
It is. I think it's, like I said about Acorns, I think having a fee was a slightly controversial choice, but I think the right one. I also don't view it as in any way customer unfriendly to have a business model that is remunerative, particularly when we're talking about $1 a month or some kind of like absolutely low fee. So I think, first of all, I think companies shouldn't always gravitate towards the easy thing, which is let's make it free. That's not actually disruptive anymore, and sometimes it's just a bad decision. I will say there are still plenty of pockets where the existing financial incumbents gouge. And so there are still pockets where you can be, you could have fees and economics and still be meaningfully better for the customer. One area is FX. TransferWise isn't free. Our company Flywire that does FX for international students, international patients, isn't free, but the average bank FX is 400 basis points. So you can come in way underneath that and still delight your customer and offer them a disruptively better value proposition. So I think finding areas of true inefficiency is where you should start your analysis as an entrepreneur. And then when you have that, where you have incumbents that are either or both disappointing or overcharging, and you can delight the customer, then you should think about how much of the economic gain you want to share with the customer versus keep yourself. But I fear the root cause problem here is not enough companies think in advance about actually is what they're doing particularly disruptive.
You mentioned the $1 a month charge for Acorns, and potentially that's a style of subscription in a way that a lot of investments firms haven't priced in the past.
Right.
Schwab recently rolled out a subscription-based offering. It's kind of funny to think about, even just a few months on. I've from time to time floated the concept to myself or to friends or contacts. Should investing be subscription-based? The AUM model seems wrong,
right,
on some level. Like, yes, okay, I guess people, you're maybe providing more value to people with more money with you, but at the same time, it's not costing you 10x to manage 10 times as much money. It's costing you probably the same. So just fundamentally doesn't really make sense. It's massively profitable if you're an incumbent investment manager, but it doesn't feel in this kind of modern day and age that's the way pricing should work. What's your expectation as to whether the subscription model in investments catches on?
Well, it's a very nuanced question, and I would actually take it up a level to all of fintech, where you have this, as people say, ad valorem, or like measured as a percent of dollars pricing in a lot of different areas, some of which make a great deal of sense and some of which make no sense. But there's been a training process. So I would say within investments, in asset management, so if you think about the products that we manufacture here at Bain Capital, it actually costs us more to put more money to work. So if you double our fund, we have to, in effect, double our team or somehow double our position size. Something has to double, and it's really hard to double these things, and it's very labor intensive and expensive. And so we do charge people as a percent of the dollars. It wouldn't make sense for me to charge Yale's endowment an annual subscription and they could get all they wanted of all of our products, because a heavy user would clearly start to burden the system significantly, and conversely, a light user would be taken advantage of. But in wealth management, the dynamics you refer to are true, which is that it's almost irrelevant. Now, there is some increased complexity often with greater assets under management. You may be, as a successful entrepreneur, a more complex client for Barclays than a simple shopkeeper, or maybe not, depending on how challenging a personality you have. And so the fact is, like, in asset management, ad valorem pricing, AUM pricing makes perfect sense to me in most products. In wealth management, it makes almost no sense. But yet the two are so closely coupled that there's been this sort of illogic pricing regime that I don't think is going away anytime soon. I prefer what Acorns has. I prefer this new Schwab program. I think financial planning has frequently been priced separately and as a subscription. And I think if you had financial planning and then truly low-cost implementation, that would get close to what I'm looking for. But if you look at payments, when you walk into a merchant here and you take a pack of gum and you give them your card, I think they should charge you differently for a pack of gum than a $12,000 necklace. Like, to me, in consumer merchant payments, ad valorem pricing makes a lot of sense, because many issues scale with dollar risk, most notably, but also it's just more money has to be extended to the merchant before it's collected. So ad valorem pricing in B2C merchant payments makes perfect sense. But in B2B, where you're paying your hosting bill, and by the way, you're paying it for the 37th month in a row, and they're quite sure who you are, and they could shut you off at a moment's notice. Should there be ad valorem pricing in that payments transaction, or should that be just, well, that's $1.50 because that's a B2B payment? So I think the fact is, sometimes you have these companion transactions that ride the benefit of ad valorem pricing that's been established already, and those things have proven to be very slow to change.
Yeah. Are you seeing people playing with that in the payment space? Or are you seeing people innovating in other interesting ways in payments?
Yeah, I think particularly in commercial payments, where in the United States it's still largely analog, where you have paper checks, and you have bank transfers, which dominate UK payments, but bank transfers are imperfect. It's a very information poor rail. So if you're in an accounts receivable department, receiving an ACH is cheap, but you don't really know what invoice is getting paid or what set of invoices are getting paid and what discounts have been applied. So B2B payments is really broken in most countries and definitely in the United States. And so people are looking to shift those payments onto more information-rich rails. And the card rails are an obvious idea for that. And they're also highly remunerative in that you can generate this interchange. And again, that's proven to be a highly durable economic arrangement. It probably gets sort of kicked back somehow in an increased price or what have you. But we're watching that space very closely. We have a number of investments who are on the accounts payable side or the accounts receivable side. Our key focus is moving the payments digital. That benefits everybody. I think the pricing will get sorted out over time.
So in doing a bit of prep for this conversation, I came across a fun tweet or a series of tweets that you have pinned to your profile, which dates back to May of 2018, so about a year ago, time of recording. And I think it was around a CEO event that you guys host annually. And there were 9 or 10 thoughts / views / rhetorical questions specific to individual verticals within fintech. And I won't run through all of them, but a couple were interesting, and maybe for two different reasons. One, because, for instance, there's point number 4 here, wealth and investing. You a year ago say all of B2C wealth companies are gearing up to launch a full suite of banking products. Finally, we get a pure test of whether the American consumer wants to switch away from their bank to a tech-oriented brand. You could have written that this morning.
Right.
Like that, I mean, has not aged a day. There's some other interesting points here around payments, which we were just discussing. Rhetorical question, are there any breakthrough innovations coming? Now that A, the original disruptors have gotten to scale, and B, much of the payments talent has turned their attention to crypto, what should we expect, if anything, next from payments? And just over the past week or two, there have been some interesting announcements. So I think SoftBank put a big slug into a German payments company, Wirecard. And I, like many, I think, was caught off guard by the $230 million purported Series A from a company called Checkout.com in the UK, which, from what I can tell, and according to the FT, is effectively an Adyen replica, offering very similar services. Have you been following either of those stories, or do you have thoughts?
I have been following both for different reasons. So Wirecard is a fascinating company, obviously with a prominent whiff of scandal. It's a Singaporean money laundering sort of thing, fraud or money laundering, something. Yeah, exactly. I was talking to a friend today about Wirecard who said, because he's a public markets investor, and Wirecard is sort of a darling short. Like if you talk to some of the hedge fund guys around New York, they love to talk about going short Wirecard.
With a higher market cap than Deutsche Bank.
Exactly. And it's been terrible. If you've been short this stock, you've had your face ripped off, as they say. And so this friend of mine, Patrick, who's a genius, said, the thing about frauds is, if it's clear that it's not a fraud, you're in good shape, stay away. If it's clear that it is, like a horrible Enron-style fraud, you can make a ton of money. The worst case is a near fraud or semi-fraud, because they're always run by these like sociopathic promoters who can do an incredible job saying like, don't pay attention to the fraud part, like focus on the really cool part of my business. And I don't know the management team at Wirecard, but the fact is they've been able to hand wave at the fraud bits such that people like SoftBank and many obviously public holders have remained long the stock. And it's been really hard for the short sellers who are running around saying these guys are frauds. Like that's not... There's a school of thought which says there is no semi-fraud. You are either honest or dishonest. But I think actually capital markets take a more nuanced view. And Wirecard has some really good businesses. They are an innovative card issuer. They've got some innovative card acquiring businesses. And this massive financing from SoftBank is a little bit like what Warren Buffett does from time to time, which is find a company that needs cash, but really that needs an imprimatur. that says this is a cool company, a good company, a safe company, not a bad company. And so
before it was Wirecard, now it's Wirecard by SoftBank.
Wirecard by SoftBank. I think it was a stroke of genius for both sides. SoftBank gets to monetize its brand name, and Wirecard gets a vote of confidence.
So quick interjection. So this is kind of potentially raises the question of the kind of kingmaker approach to capital deployment.
Yeah.
Do you have thoughts on that space? I mean, most investors, as good as they may be, aren't in the position where they can kind of wave a massive check in front of one company and say, take this money and be wealthy, or I'm going to give it to your competitors.
Right.
So I don't know, what does that do to the market dynamic?
It's been a new factor. There was, at the early stage, there was a little bit of this in that you would have a certain set of firms, sometimes just in a segment, who were very good at fintech or very good at commerce or what have you, who, if they got involved, people would say, well, maybe that's the winner. Or like Sequoia or potentially Benchmark, good at everything, and if they got involved in any company. But I think what's happened now in the early stage is that if Benchmark or Sequoia fund something, that actually immediate thought is, what else can we fund that looks like that? So I think that winner, that sort of king making at the early stage has now backfired to where there's so much money out there that if one of the smart guys like a Fred Wilson
shooting up a flare or something.
Yeah, they're shooting up and the copycats come quickly. So what's emerged in the absence of that is the late stage version where somebody's going to get that SoftBank money and it's either you or your competitor. I think we won't know for another 10 years what the post facto analysis suggests. I think it's far from obvious that a war chest alone is that much of a thumb on the scales. I think there'll be plenty of companies that don't get the SoftBank money and end up winning in their category. Well, they clearly already have been, but I think this is not a break point in history where they will be in all the winners. So I admire their strategy. I think it's distinctive, and they're the first to do it and the only one at scale doing it. But I don't, for instance, encourage my companies to cultivate, that relationship at all costs. I think there's lots of ways to win.
Yeah. Do you expect other SoftBank-like investors to follow suit eventually? Does anyone else have that sort of firepower?
It's hard to think who might. There's because it's a gunslinging strategy. And so if you think of the 2x2 of, not a lot of money, a lot of money, and conservative versus gunslinging, like the box in that 2x2, which is a lot of money gunslinging, is pretty lonely. There's for a reason.
Especially in banking, right?
Right. As the dollars get bigger, the sense of fiduciary tends to grow. And so obviously firms like BlackRock, Fidelity, there are these massive $1 trillion plus asset managers for whom $100 billion would be meaningful, but not wouldn't define the strategy of the firm. But those don't seem at all likely to pursue that kind of strategy.
Well, that's interesting because it almost feels like companies like that would be best served from pursuing that strategy, given the way that margins are going in that space.
Yes, those companies actually would be well served, I think. I just think there's plenty of voices around each of those tables that say that tech is cyclical. Anyone who's been investing for 30, 40 years understands that, or forget about understands, has enough pattern recognition to at least be swayed by the idea that what's happening now in tech will end. And I think there's a contrary view that SoftBank holds and many in the Valley hold and that I entertain from time to time, which is that, no, this is not cyclical. This is secular. Tech is, fintech 20 years ago when I started doing it, just simply didn't exist. It was not a thought that you could build multi-billion-dollar businesses in financial services that would be considered tech companies. And now it's clearly, and maybe even obviously true, and in transportation and in travel. And so if you think about tech that way, you think about SoftBank's opportunity as the tech disruptors in every segment of the GDP, then it doesn't seem cyclical.
I mean, I guess those who would call it a secular shift would kind of say this is like electricity. Like it's here and it's not going away, and every business is going to leverage its power going forward, regardless of cyclicality.
Precisely, and if you think about it in that way, I think if you were in the boardroom at BlackRock, you might be more persuasive in arguing for not just an incremental tilt towards tech, but kind of a massive shift towards tech. But then there's the how do you execute on it? How do you mean SoftBank has had a brand and has had a team in this field for 2.5 decades. And so they were able to put this effort together on the backs of talented individuals and a charismatic visionary leader who eats and breathes technology. Not so of the colossal incumbent asset management firms.
Yeah. So I'm sorry, I got a sidetracked before. Checkout.com.
Oh, yes.
What do you know about them?
So I know them well. I met the founder, actually lives in Dubai, of Swiss origin, but most of the company is in London. I met him 4 years ago. And he has been in this incredibly quiet, under the radar way, competing with Adyen and Stripe for scale, particularly cross-border e-commerce companies, to provide them with an alternative, sometimes at the same time and sometimes an all-in-one solution for their highly complex needs.
What makes it different or better than Adyen?
Configurability is what they would say, and this is a blessing and a curse. But Adyen more or less is kind of, take it or leave it. This is our stack. And Checkout has built a system that is highly configurable, carefully not to say customizable, but highly configurable. So if you have a bunch of bespoke requirements, you're much more likely to get a sympathetic ear and a flexible solution from Checkout than you are from Adyen at this point. And so there's many situations where they can both win, and they split the volume either by corridor. Some countries are Adyen countries, some countries are Checkout countries, and then some merchants overall who just prefer a highly configurable system to you can have it whatever you want as long as it's blue, kind of Adyen style solution. Yeah. So that would be their answer, and it's clearly served them well.
Yeah. Well, this news jumps out for a couple of reasons. One, of course, the size of the check and the fact that they kind of bootstrapped to date. But if you ask anyone about the origins of fintech, kind of post iPhone, payments was kind of the leading edge,
yes.
And it hasn't really gone away. It was a pretty well, I suppose it was ripe for innovation, but it was also mature and relatively technological even before fintech. Visa and MasterCard. It's hard to suggest they're not technology companies. Then of course the likes of Square and then Stripe and Adyen and so many others, PayPal. Yet you're still seeing, at least this recent fundraising would suggest, massive greenfield opportunity. Is that optimizing around the edges of a market that's just so enormously big that a basis point is a multi-billion-dollar business, or does this kind of continued technological development, if we move from offline to online to mobile to potentially, voice to hybrid, augmented, physical, digital commerce, like does that create new requirements in payments that support new companies?
I fear not. I think to think of the Checkout financing as a Series A, while technically correct, is actually semantically not that useful. It really is a 10-year-old company that is far more part of that last wave, which is now at scale, than any kind of next wave. And I think e-commerce and mobile commerce, relatedly, were created new payment problems and a whole slew of payment companies that got set up to solve those payment problems. And then there have been successive generations of quality within that movement. But I think we're still waiting for the next set of payment problems to be solved. That we thought maybe crypto would be a payment type. It's not proven to be any kind of payment type. And so there are no new interesting payment problems in crypto. There's a hot minute of cannabis being the new set of payment problems, but it's just too small, and they're not even new problems; they're just regulatory wrinkles. So the facts remain that in terms of true Series A investment, payments companies there are fewer payment Series A's in 2018 than in 2012, and it's been a steady decreasing slope. I'm leading my first Series A in a payments company in 5 years, just now. And that's an awfully long drought for someone who fancies
Are they solving a new problem? Is it a radically new solution?
Yeah, so they are solving a new problem, which is that, and as I think about this year's CEO Summit, one of the things I'm going to be talking a lot about is the continued progress of the intermediation of payments by software companies, which we talked about a little bit last year, but is the major trend as I see it in payments. The fact that commerce is moving online is inarguable and created a bunch of payment opportunities. But within payments, what's really interesting is that if you're any kind of merchant, you're much more likely to buy payment services from a non-payments company today than yesterday. And in the future, that will be dramatically true, whether it be Shopify, if you're an e-commerce merchant, or whether it be House Call Pro, if you're a plumber, or whether it be MindBody, if you're a yoga studio, or whether it be Lightspeed, if you're a traditional retailer. So there are all these software companies that are doing broadly defined point of sale and ERP software functions on behalf of, again, broadly defined merchants of all types, service providers as well as retailers. And those companies are newly looking to get into the payment stream. Not brand newly, but with a new vigor. And 10 years ago, the models that were established were in effect referral relationships. So if you were a yoga studio that used MindBody software, you could go through them to get to Bank of America Merchant Services, or get to First Data, or get to WorldPay, open a merchant account, and the two would be loosely coupled, and MindBody would make a referral. But now, companies like MindBody actually want to underwrite you themselves and become a payment facilitator, really become, in effect, an ersatz payments company, and have that whole payment experience be tightly integrated and capture much more of the economics.
And on a related point of sale finance, for consumers, I guess, the likes of Affirm and other large lending companies, where do you see that most naturally fitting into the kind of fintech taxonomy? Is that a freestanding vertical, or does that become kind of a product that's rolled into either a kind of consumer fintech proposition, or maybe it's associated with a Lightspeed or MindBody proposition? So
we've voted with our feet on that issue too. So the two early stage deals, one in payments, one in lending, that we've done in the past 6 months are a company called Fintechs Payments. Fintechs is a software platform that helps these software companies like a Lightspeed, in fact specifically Lightspeed, become a payment facilitator. So they're like picks and shovels around a vision where their vision, that all these software companies will become payments companies, and Fintechs enables them to do so. The other is a company called WiseTac, which is the exact same architecture in point of sale lending. So to me, quite logically, a plumber that uses House Call Pro, or to take a Lightspeed example, a retailer who uses Lightspeed, they could go to Synchrony. They could separately go to Synchrony or Affirm or Bread and kick off a bespoke point of sale lending company, but rather they should, through Lightspeed, integrated in with Lightspeed Payments, offer that functionality. All of it should be tied into their inventory system and everything else that Lightspeed does for them. And that plumber could go to GreenSky, but in fact, in the future, I think we'll go to House Call Pro, their payments vendor soon, and it should become their point of sale lending vendor.
Are the Affirms of the world taking that approach at all? Kind of the B2B to B
a lot of B's.
Positioning?
No, Affirm, I think, has a great, valid, separate strategy, which is to build a consumer brand. And so any kind of white labeling, I think, is counter to their interests. They really want to be in the face of the consumer, so much so that they want you and I as consumers to, when we're in a commerce context, be saying things like, do you take Affirm? So they're not well set up to pursue an integrated strategy.
Is that maybe to my point from before? Is that the sort of thing that you might see fitting into a consumer fintech, a broader consumer fintech proposition? Like, why should that be a standalone product?
They would say, well, American Express is a standalone product. They built a merchant network and they built a consumer network. It's not easy to do, but if you get it right, it's worth $36 billion. So that would be the argument. Contrary to that would be to say, well, Visa and MasterCard have already invested a lot in building a network. And so a consumer fintech, all they have to do is issue a Visa or MasterCard, and they can be, in effect, a firm, accepted everywhere, and pay that merchant on debit rails and charge the consumer a credit transaction and do a very specific kind of point of sale financing transaction with a customer they've already acquired. So I don't think it's there isn't one winning model or one losing model. The Affirm model to me is inarguably more ambitious, and the Acorns or Chime launching this product is more achievable in that it's a few lines of code and a third-party balance sheet. I trivialize it. It's obviously more than that, but there's no doubt that in the midst of this rebundling, point-of-sale lending will be a component of the game plan of all of these rebundled B2C fintech companies.
Yeah. On the kind of back to the subject of payments, and you mentioned crypto. How relevant, if you've been following it, is the reported Facebook foray into the digital asset, kind of supporting commerce on the Facebook platform, low exchange fee kind of transactions, plus presumably some sort of smart ad conversion piece in potentially a bit of a crossroads of payments and commerce and advertising?
Yeah. Well, I think there's two questions. One is Facebook big enough and important enough to get its ecosystem using a new type of currency? Will all of us as Facebook users create wallets and accounts and store value in a new type of currency? Will their advertisers, presumably their advertisers, will use whatever Facebook tells them they have to use?
Right?
And then will their commerce partners, accept it, et cetera? Can they cajole or bully the various elements of the Facebook ecosystem to transact using Facebook coin? Question one. Question two is, should it be a normal currency, which is to say they're the central bank, or a cryptocurrency, which is to say it's trustless and permissionless and runs on algorithms? To me, 99% of the question is the first question. So I'm skeptical that they have enough clout. Now, I think what they would say is that the questions I separated are inseparable, that Facebook has a trust problem. And so it's only by introducing a crypto mechanism that, in other words, that mechanism is what permits them, gives them the ability to get their ecosystem fired up, because they can say, hey, this isn't Facebook coin. This is
a massive bait and switch. They created all the privacy issues, so then they could say crypto solves them because it maintains identity and data ownership. And
I'm pretty sure they would do away with the privacy concerns if they could. I think they would at least cite those issues, though, as justification for why this thing has to be crypto. But again, it strikes me like most crypto-flavored things as the question that they started with actually was, what can we use crypto for? This seems cool. And then this is where they ended up, versus a more of a first principles approach of, should we have our own currency? Yes, no. If yes, should it be crypto or like all the other currencies in the world? I mean, I personally think it would be much more efficient if they just issued their own currency. I don't think there's a real use case for it, but if there is, I don't see how it's meaningfully helped by being crypto in nature, personally.
Yeah. So to wrap up, you mentioned the CEO Summit, which I think you guys are preparing to do again imminently.
This week.
And you talked about what your approach, some of your messages to your CEOs is likely to be this year. Anything else you'd like to share on that front?
Yeah, I mean, so there's two main themes I've been exploring. One is verticalization. So we are seeing, you mentioned electricity earlier, and the example I usually use is the internet. It used to be 20 years ago, people would say that they're an internet company. And nobody says that anymore. It's laughable, right? If you're not using the internet, you don't have a business. And fintech, it feels like it's on that path to me, that there won't be fintech companies per se in some small number of decades, that payments, like we were talking about, House Call Pro, which is a software company that serves plumbers, will be a payments company, but they won't tout that. It'll just be like one of the ways in which they solve customer problems and they monetize. They will have lending enabled. And again, that will just be a way to both monetize and smooth the operations of everything they do. And so we're seeing this across payments and lending and insurance and investing, where everything's becoming subsumed in software and then verticalized. So it's solving much more interesting customer problems than discrete, I want to buy a stock problems, or I want to insure against that risk, so I will go to my broker and buy a policy. All of these architectures are being diffused into software and then highly verticalized. Now, that's like we're in the second pitch of the first inning. I'm not sure what the cricket version of that would be, but I don't know. Asking the wrong guy. We're in early days. We're in the first dart of a match, or whatever. But this is, to me, it's as clear as day. That's why we invested in Finex and Wisetack. We are both investing in the infrastructure behind these, as well as a lot of the payments and lending, and investing in insurance companies that are saying, look, I'm not going to go out there in the future and say, hey, come buy my homeowner's insurance. I need to be embedded in the software where homeowners are when they're making other decisions. And it's only there that I will economically be able to sell my homeowner's policy. So that's, I'm going to spend a half hour exhorting people to think about this and about how their business model is future-proofed in that way.
Excellent. Matt Harris, thank you very much for joining us today.
It's my pleasure. It was a great conversation. Thanks for having me.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.